Well, we had some interesting speakers so far. I enjoyed it tremendously. We have one more group here, and this is going to be on 1031 exchanges, which is a very interesting topic. And it's brought to you by Patrick Deibler and Sam Goodley from Glick, Goodley, Deibler, and Fanning. They're very interesting speakers, so I look forward to it. Come on up.
Don't say that, Wilmer. Get their hoops up.
Normally at this block we're reading terms and conditions. We're not giving speeches. So thank you, Wilmer. Thank you, Chris. Pat Deibler with Sam Goodley. We are two attorneys at Glick, Goodley, Deibler, and Fanning, which is our law firm. We also have an in-house title agency called Lancaster County Settlement Services, which some of you may or may not have utilized before, and we also have an in-house qualified intermediary. That term will make a whole lot more sense in a couple of minutes. Naturally, Chris, you picked the driest of subjects to do last. So I apologize in advance. Unfortunately, the nature of 1031 exchanges is it doesn't really lend itself very well to a fancy PowerPoint presentation, so you're just going to have to listen. And so just a couple of broad disclaimers before we get into the meat of the 1031 exchange. And so the first is that we are going to take a 5,000-foot view of the subject. Conceptually, 1031 exchanges are fairly easy to understand, but as you start digging into it, that's where the complexity arises. And so we're going to stay at that 5,000-foot view. The reason for that is because in many instances, the answer to the question asked by a client regarding a 1031 exchange, the answer itself is the product of three individuals. The attorney, who I would argue is probably the least important in the equation, the qualified intermediary, who's probably next up in terms of the importance, and number three, the accountant or the CPA. Many of the questions we get asked on a regular basis as they relate to 1031 exchanges, the response from us is, you gotta check with your accountant. Because the answer to the questions of should I, or how much will I save, or does this even make any sense, is going to be a product of your individual basis in that property, and who better to know that than your accountant or your CPA. And so I always want to point that out, because in many of the interactions we have on the subject of 1031 exchanges, we are asking you to bring your accountant or your CPA into the conversation so that you're getting the best information humanly possible. And so with that said, out of curiosity, how many of you have undertaken a 1031 exchange or like-kind exchange before? Okay. For those of you who have raised your hands, I apologize. You're not going to learn anything new today. You are welcome to fall asleep for the next 20 minutes. It's entirely up to you, right? So when we talk about a 1031 exchange or a like-kind exchange, so we are talking about a type of real estate transaction like any other settlement that allows you to sell a piece of property and then replace it with another piece of property that is of equal or greater value. Right now, some nuance and color to that, but just some terminology very quickly. That, because we're going to refer to it over the next 20-25 minutes, right? That property that you are selling is called the
Relinquished property.
And the property that you are buying or exchanging into is
Replacement property.
relinquished property and replacement property, right? So we use those, we're going to be throwing those around a lot, so it's a good idea that you understand that. Now, I made that comment about equal or greater value, and we'll get into this a little bit more in a couple of minutes, but we call that, I call it the perfect exchange, right? In which case you are deferring the entirety of your capital gains burden into another property, right? So I call it kicking the can down the road, right? A perfect exchange is one in which you kick that can as far down the road as you can. But that doesn't necessarily mean that you can't do an exchange into a replacement property that is of lesser value than the one that you are relinquishing. You can still do that, it just has tax consequences, which we're going to get into in a couple of minutes here. So that, at 5,000 feet, is what a 1031 exchange is. We are, in essence, taking an investment property and then selling it and replacing it with another investment property. The product of that is we are deferring our capital gains tax on that investment property.
And the key there being deferral. It's called a tax-deferred exchange for a very specific reason. Patrick used the expression kicking the can down the road. That's always what you have to remember if you're thinking about doing a 1031 exchange. You are not completely eliminating the capital gain tax. You're just pushing that capital gain tax into the next property that you're purchasing. So long as you continue to do 1031 exchanges, you continue to trade equal or up in value, you're not going to pay the capital gain tax. The tax that you saved in purchasing the property, that money is working for you because you're using it to buy the next property. You eventually sell that property, you stop doing 1031 exchanges, and all that capital gain tax comes calling. Farmers regularly do this, or just property investors in general. They'll sell a property, buy another property in exchange using the proceeds. Maybe they'll preserve it. They'll use the proceeds from preserving it to do an exchange and buy another property. Maybe they sell both of those properties and buy 2 more farms. As long as you keep doing that, you're deferring your capital gain tax. But the moment that you sell a property and you don't do an exchange, all of the tax that you saved over the years comes back. The only way to avoid it is by dying. If you pass away and you still own the property and it goes to your children in your will, the general principle is your children receive what's called a step up in basis, which basically means that if they sell the property for its fair market value as determined at the time of your passing, generally speaking, they don't pay capital gain tax.
Until the future when they do.
Oh, until the future when they do. Yeah.
Right, so that old adage, death and taxes, well, 1031 exchanges, it's the perfect example of that, right? You are kicking that can down the road. If you pass, you've kicked that can to your kids, but now they got to start kicking that can too. Otherwise, the tax bill will come due and get the stuff. Yeah, and so, and I suspect Ashley and Tom covered this a little bit in terms of capital gains tax and the actual tax rate, but the longer you hold on to your investment properties, there's a different tax treatment, right? So the general rule of thumb with 1031 exchanges is that if you have engaged in real estate investment in any way, shape, or form, you want to try and hold that asset for a period of time so that you have a preferential tax base or a tax rate if you don't do a 1031 exchange. But so that is the broad strokes of a 1031 exchange. So let's peel back the layers a little bit. And so one of the questions that we get asked regularly is, does this even apply to me? Do I qualify for a 1031 exchange? And the first thing we have to figure out is what exactly are you exchanging, right? So like-kind exchange, investment real estate for investment real estate. Now, my understanding is well before my time, prior to the revision to the tax code, that you could actually exchange real estate for things, right? So you could exchange real estate for a boat or a private jet, or vice versa. Well, that's not really like kind now, is it, right? And so that loophole was closed sometime before I started practicing law. And so we're really talking about an investment property for an investment property. Now, because we are speaking to an ag group, right, there is some nuance to that, right? Because how many of you own farms, out of curiosity? If somebody asks you what you do for a living, are you going to respond, real estate investment? No, I'm a farmer, right? So all that means from a 1031 standpoint is that we have to figure out, how do we take this parcel of real estate that, for the most part, in one hand is my primary residence, but on the other hand is also my business, but also let's add another layer to that. We've been making capital improvements for investment purposes too. So does a 1031 exchange apply to me? Well, the answer is most likely yes, right? Because what we can do in the lead up to the 1031 exchange is we have an appraiser who can go out and bifurcate the property. And by that I mean take the portion which is the primary residence and separate it from the agricultural component to the property, basically giving us two values, right? So we know what the primary residence is, but we also know what the value is that we can utilize for the exchange. And so a lot of people who have farms will think because they live there and because it's where they have their trade or their business, they can't do a 1031 exchange. They absolutely can. But in general, we are talking about investment properties for investment properties of equal or greater value to perfect that exchange.
The point there being that you already get a significant capital gain tax break if you sell your personal residence. So we're just kind of pointing at the difference between the residence portion of your farm, which you cannot include those proceeds in a 1031 exchange, and then the rest of it, your ag buildings, your land, that's all presumably eligible for use in a 1031 exchange, simply not the portion of the sale proceeds which go to your residence itself, because there's already a tax break for that.
And that's why, going back to a point we touched on earlier, like this is why the interplay with your attorney, with a qualified intermediary, with the accountant in particular is so important, because who is the one who is keeping track of all of your depreciation? Not your attorney. Who is the one who is filing your taxes and who can give the solid answer of A versus B? It's your CPA, it's your accountant, it's not your attorney. So that's why in the conversation, it is mission critical that the first thing you do when you reach out to your attorney or your title agent is say, and oh, by the way, I use McClarigan and Associates, or oh, by the way, this is who I use to file my taxes, because chances are pretty high that if a question is asked and it's asked of the attorney's going to say, well, we need to check with the CPA. Or if it's asked of the qualified intermediary, they're going to say, well, we need to check with your CPA.
In general, all the qualified intermediary does is hold your money for you after you sell your farm or sell your investment property, and then prepares the paperwork and spends the money when you purchase your replacement property. The qualified intermediary, as a general rule, won't give you tax advice. If you call me up and say, Sam, I'd like to do an exchange, and can I do this? Does this make sense? I'll say, please speak to your accountant and then call me back and tell me that your accountant said that you need to do an exchange.
And that's going to make a whole lot more sense for some of the, I call it esoteric types of exchanges we're going to get into here, right? But so that line that we had said just a couple of minutes ago, greater or equal value, right? So the reason why that is important is because if you have an exchange where you are relinquishing something of greater value than the thing that you're replacing, it creates this concept called boot, B-O-O-T. We'll define boot a little bit more in a couple of minutes here, but boot is the thing that we are always trying to avoid in a 1031 exchange, because any assets that are not utilized in a 1031 exchange are subject to capital gains tax. And so if the whole exercise is to kick that can far enough down the road that we don't have to pay capital gains tax, well, why would we engage in a 1031 exchange with all of those associated costs, only to have to pay capital gains tax, right? So you really want to shoot for equal to or greater value. And if you want to put yourself to sleep and you read the legislative history as to why it is the case, it's because we're trying to encourage the building of value, the building of investments, right? So you always want to try to avoid boot. A perfect example of that would be if I sell a property, my relinquished property, for $500,000, but I only reinvest $400,000, I have $100,000 of boot. We don't want that. You also must have substantial gain to justify the 1031. This is where the accountant is mission critical, because your attorney, your settlement agent, they're just looking at the raw numbers. You're selling a property for $500,000, you're replacing a property for $500,000. That's probably all we know, right? There's a lot more color involved in that transaction. There's depreciation, there's mortgages, there's all sorts of things that could come into play to answer the question of, does this make sense for me, right? And the reason why that is important is because on average, if you're doing what we're going to call a standard exchange, we'll get into that in a couple minutes, right? Your fees, depending on your qualified intermediary, are going to be anywhere between, let's say, $850 and $1,200, right? Fair?
A standard deferred exchange.
Standard deferred exchange. There's this thing called a reverse exchange, which we're going to get into in a second, right? The cost for a reverse exchange? Substantially higher.
Probably depends on the transfer tax mostly, but I think most companies that do set you up for a reverse exchange, last I heard was $9,000 for the minimum fee just to do the legal work or the exchange work.
Yep, I've seen $9,000 to $15,000 depending on the qualified intermediary. And then when you get into really funky exchanges like the construction exchanges, those fees can be $20,000, $30,000 plus $1,000, right? And so if you are engaging in an exchange to save $15,000 of capital gains tax, but it's going to cost you $15,000 to do it, maybe it doesn't make a whole lot of sense. That's why the CPA, the accountant, is mission critical. And just like the like kind exchange, where we have to replace the real estate for the real estate, the parties also have to mate up, right? So if I own an investment property individually, and I want to sell it and perform a 1031 exchange, well, it means that I then have to be the one owning that replacement property, right? So Patrick Deibler sells and Patrick Deibler buys. Sam, what happens when you have an LLC or an entity?
And even, by the way, even if Patrick Deibler is married, which he is, his spouse, his wife, cannot go on the deed for the replacement property because she was not on the deed for the first property. But to directly answer Patrick's question, it is certainly possible to do an exchange with an LLC as the owner of your relinquished property, the one that you're selling. You just simply have to take title. You have to purchase the next property, the replacement property, in the name of that LLC, with a possible exception. This is a talk to your tax accountant point here, but it is possible that if the LLC, which owns your farm or owns your property, has owned it for at least the last 2 years, it can deed the property to the individual LLC owners. As long as it's in the same percentage as the LLC owners own the LLC, the property can be deeded out to them. This is called a partnership distribution, where it is a partnership distribution. In this case, this is how, so say you have a partnership with your brother, you own a farm together. He does not want to do an exchange, but you would like to do an exchange with your share of the proceeds from selling the farm. So you say, okay, well, we can't buy this new farm with this LLC because you want no part of this. You'd like to take your cash out and be done. I would like to. We have plenty of time to do this. So we're going to do a distribution. We're going to have a deed prepared from our LLC to ourselves in the same percentages that we own the LLC. And my understanding, my best understanding, is that after this distribution occurs, that you must wait at least one tax return filing before you then go and purchase another property in your personal name to do an exchange. This is a talk to your tax accountant question because it probably depends on their risk tolerance and their willingness to advise you to do this quicker than one tax return filing, but that's my general understanding of that particular subject.
Yeah, general rule of thumb with 1031 exchanges is you always get questions of, well, how long should I wait to do X? And you always, for the most part, get a response of 2 years, right? Where does that come from? Well, it doesn't come from the tax code, right? Nowhere, as far as I can tell, nowhere in the tax code is there any temporal requirement for 2 years, right? It's that one complete tax filing. So unless you are doing the exchange on April 15th, which gets you 1 full year, realistically, on any other day in the year, we're looking at 2 years to be able to get over the other side of that threshold there. Now, you touched on it a bit, and we've talked about it a lot. What is a qualified intermediary?
Oh, okay. All right. So the core of a 1031 exchange, this is a deferred exchange because there is a type of exchange called a simultaneous exchange, which, if I don't talk too much, we'll get to, which does not require a qualified intermediary. But in general, the type of 1031 exchange that most people do, you sell a property, then you buy a property later on. That's the simple kind, which I call a deferred exchange. That's what the IRS calls it as well. So the moment, so say you go to settlement and the settlement agent gives you a check and you take that check, you go deposit it in your bank account. At that moment, you are cut off. You are not able to do a 1031 exchange. You can never actually have the money in your hands and you can never have control of it, which is where this qualified intermediary comes in. The intermediary is something that stands between you and the money and the property that you'd like to purchase. So the idea with a deferred exchange, you identify your qualified intermediary before you go to settlement on the property that you're selling. You sign what's called an exchange agreement with nuts and bolts of how exchanges work. And what the qualified intermediary is agreeing to do on your behalf is to get the money from the sale of your property. You sign a document called an assignment of sale agreement, which gives this company or this qualified intermediary your legal right to receive your proceeds from selling the property. The company then gets the money, it sits in an account until the time comes to spend it on the next property that you'd like to purchase, or until you run into trouble with time periods and you are not able to complete your exchange, at which point it gets paid back to you. But that's the core of a deferred exchange, is a qualified intermediary which stands between you and the money. It holds the money on your behalf. When the time comes for you to purchase your next property, the qualified intermediary will make sure the money goes to the settlement company, which is handling that purchase on your behalf, spends the money on your behalf, and the property is then deeded directly to you.
And it's not going to be a shock to anybody in this room, but because we were talking about capital gains tax and the IRS, this is a reported transaction, which means that there is a form called the 8824 through any 1031 exchange that gets reported to the IRS, so they know. All right, so let's talk about the 4 general types of exchanges. And so we say 4 because there are 4, but the harsh reality is that the vast majority of 1031 exchanges fall within 1, right? So the first one is what Sam defined as the simultaneous exchange. It's an exchange that does not require 1031, and it's an exchange where settlement occurs at the same time, right? For the relinquished property and the replacement property. That's fairly rare. I think in 16, 17 years, I've had one.
Yeah.
I've had one.
I think I've probably seen 3 that I've helped with.
The vast majority, because the timing is very difficult. We're going to get into the timing in a bit here, but the idea that you can buy and sell a property on the same day, right, means that the stars have to align perfectly. It doesn't happen very often. The most common type of exchange is what we call the standard or deferred exchange, which is you settle on the relinquished property, and then a time period later you Ashley? Oh, yes, I know. I'm hurrying it up. So you settle on a property, and then at some point in the future, you replace that property, right? The deferred exchange. It's deferred because the settlement on the replacement property is occurring afterwards. Qualified intermediary is very much involved. Then there's the thing called the reverse exchange, which is the type of exchange that keeps us up at night, right? It is an exchange in which you've already purchased what will be the replacement property before you sell the relinquished property. Those are very complicated. Those can get very expensive. And then last but not least, we have the construction or improvement exchange, where in addition to purchasing the real estate that is to be your replacement, you are also setting aside funds for the construction of improvements of some sort on that property. So for instance, you buy a farm, but it doesn't have any ancillary buildings, and so you use funds from the exchange to build the barn, to build the chicken house, to build this, that, and the other thing, right? Those are the most expensive because they require the creation of what is known as an EAT or EAT, which is a special entity created by your qualified intermediary to hold those monies, hold title to the property, and actually pay the contractors, right? So those are the type of exchanges you see in very expensive commercial or industrial improvements, right? Not so much on ag, although we have seen it with ag before. So we're talking about exchanges. Those are the type of exchanges that we're talking about. So the most critical aspect of the 1031, in my opinion, is the timing, right? And so that's what we're going to talk about next. 1031s live or die by the timeline. It is very common for us to get calls from potential clients who say, hey, I just settled on my property. I heard this thing called a 1031 exchange. Can I do one? No. The answer to should I or can I occurs well before the settlement of your relinquished property. And so we have 2 general timelines that we are following: 45 days and 180 days. Sam?
Okay.
45 days.
45 days, beginning on the date of your settlement upon which you have sold your relinquished property. You have 45 days to do what is called identify. It's your identification period, which essentially means, identify your replacement properties. So if you do a 1031 exchange with a qualified intermediary, they'll talk to you about this in advance. They'll give you some identification forms. It's simple. You write the name of the owner, the property address, the parcel number, whatever other information you have about the property. As long as this is delivered to the qualified intermediary by midnight on the 45th day after your sale of your property, then you have successfully identified that property. There are limitations on the number of properties that you can identify or on their value, but that is the most urgent time period that you have to deal with, 45 days. I always encourage people, try to find your replacement property before that 45-day clock starts to tick, because probably a lot of you guys have tried to find a property on, maybe some of you have tried to find a property on fairly short notice. It's a little bit difficult to do these days.
Especially in this market. Yep. And then 180 days, right? You have 180 days from the settlement of your relinquished property to then settle on the replacement property. So you have a little bit of wiggle room. But the most difficult timeline, in my opinion, is that 45 days. It almost forces you to be looking well before you sell your relinquished property. And many of the real estate agents and auctioneers that we work with on a regular basis, they field regular calls on this subject. Hey, I have this property that at some point I would like to sell, but before I can do that, I really kind of need to have an idea of what options are out there for me, because I'd like to do a 1031 exchange. And so, well, now we've actually brought a fourth component into this equation, right? The auctioneer or the real estate agent. And so going back to the point Sam said, right? The identification period. So like-kind exchange, real estate for real estate. But that doesn't just mean that I'm forced to sell one and replace it with another. I do have some flexibility. And there are 3 general rules when we talk about replacements, right? The first is the 3 property rule. which is this rule states that the real estate investors can identify and purchase 1, 2, or 3 properties under the delayed exchange, right? So in other words, I sell 1 and I'm buying 3, up to 3. I can do that. Then there's another nuanced rule, the 200% rule, which is that under this rule, you're able to choose more than 3 replacement properties. However, the combined value of those properties must not exceed 200% of the value of the relinquished property. Ooh, it gets a little bit more difficult. And then finally, the 95% rule, which is building off of the 200% rule. This rule states that real estate investors can identify more than 3 properties with a total value of greater than 200% the value of the relinquished property, but you have to settle on at least 95% of those properties. So the more you add into the equation, the much more difficult it becomes to perform the exchange, which means that the odds of it failing are higher, right? So that is why, going back to our point, where the most common exchange is the delayed exchange, the 1 for 1, or the 1 for maybe 2. On occasion, I've seen 3. But I don't believe I think I've seen the 200% rule once. I don't believe I've ever seen the 95% rule. Ash, have you ever seen the 95% rule? Oh, she's not even paying attention. She's Louise. Have you ever seen the 95% rule? What, you have? One time, yeah. So very rare. When you consider that we probably do, I don't know, between